Okay, welcome everyone. We'll start our last lesson about Unit 1, Financial Reporting, level LO3, Lesson 3. My name is Anjum Satar and my email address anjum@ukversity.co.uk. Happy New Year to all. So we'll start our last lesson regarding LO3. So in LO3, we'll discuss first what we're supposed to be learned so we can go through and recap what we already learned before, and then we can start our proper lesson. Okay, so lesson 1, during lesson 1, we learn about be able to prepare the financial statement. We discuss 4 types of financial statement we prepare in accounts. So we discuss statement of comprehensive income, statement of financial position. We discuss statement of change in equity, statement of cash flow. And we discuss difference between sole trader and partnership. We learn about various adjustment. We discuss double entry bookkeeping as well. And we discuss we discuss different stakeholders and their expectation, and how we can keep in mind, when we prepare, and how stakeholders can use the information to make the financial decisions. All we learned during our lesson 1. Lesson 2, we discuss about prepare companies financial statement. We discuss about limited companies. We discuss Company Act 2006 in UK, and which updated 2011 again, and we discuss about Company Act 1984 in term of in India and other part of the world, different Company Act. We discuss difference between the private limited and public limited. Private limited issue the shares to the private investor, and the public limited issue shares to the public. They're registered with the stock exchange, and they have to publish their financial statement on the public domain. All this we discuss during second lesson. We discuss how many types of financial statement we prepare. Again, we discuss 4 types of financial statement. We discuss types of errors and how these errors we can make adjustment, principal errors and errors those affect the trial balance. And we discuss end of year adjustment. We discuss accrual and prepayments, and we discuss end of the year adjustments as well. Those we discussed during our last lesson. Today we'll move forward, then we'll go through our lesson 3. Lesson 3 is be able to interpret financial statement and make justified recommendation so can be financial statement. So as we discussed in the first lesson, second lesson as well, financial statement in terms of the limited companies. We discussed there are the 4 types of financial statement we prepare in accounts. So financial statement provide the financial information. If you want to know about the company profit and loss, income and expenses, are all we can find within the balance sheet. So we'll go through here. I'll show you as well. So like if we look this company, one of financial statements. So we have here 2 companies, and we've been given the 2 years result. So we've been given the Anika and Papika, 2 companies. We've been given the revenue. So Anika revenue and Papika revenue. So Anika revenue is higher than the Papika. We've been given the cost of sales, and the cost of sales Papika is a higher than, and gross profit, of course, Anika is a higher gross profit. Then we've been given different sort of expenses. So we can make a lot of decisions about the distribution cost. Why distribution cost is a higher than Anika than Papika, and administrative expenses and profit from operation. And when we look finance cost, and we can make the decision to reduce these, and we'll see there Anika's sales were higher, but the profit was lower, and Paprika's profit is higher than the Nika. Even the sale revenue was lower. So that's, the Paprika's expenses are lower, so end of the day the profit margin is a high. So that's we can look around as well, and we can calculate different ratio to further interpret the information into usable decision in the percentage as well. So then we have a balance sheet. We can look around a whole accounting equation, guys. Do you know the accounting equation which you already learned? Assets equal to liabilities plus capital. And we know the asset. I have two types: current asset and non-current asset. Asset is anything we own it which will flow the future economics benefit, we can call asset. So here we can go through the asset. Property, plant, equipment are non-current asset. Other can be intangible asset as well under non-current, like a goodwill, patent, copyright. So current asset, any asset which we can consume within 12 months, those called current asset. So we have inventories is current asset, trade, another receivable, cash and cash equivalent. These are all assets. So these are the current asset of both companies. And then we can look around equities and capital. Equity mean the share capital, how much they have a more shares than they have. Return earning is quite a lot. Paprika is very less. Non-current liability, which is known as a long-term liability. Anika has less liabilities than Paprika, so it's more commitment long term. So current liability which we have to settle within 12 months. So then we can look around the current liabilities. For Anika, he has been given Anika's current liabilities and Paprika's current liabilities. Paprika's current liability less than Anika. So we can compare and contrast, and we can evaluate, we can make decision how we can, because to get the competitive advantage, we have to make the right decision at the right time. So all these, the figures is really important in the financial. So then we can based on different formula, we can calculate different ratios, and we can further interpret and will make the decision, which we'll do in the later today lesson. So we will start now. So today lesson we have our LO3, which we'll go through. So LO3, be able to interpret. So we interpret the financial information and we draw the recommendation and we can make the decision. Evaluate accounting record. Yes, these are the financial statements are accounting record as well, which provide the financial information. In the management accounting, those are the record internally available, but the financial accounting record can be available for external user. So make justify recommendation. Yes, we can make justify recommendation. We can analyze different ratios. We can evaluate the record, and then we can prepare the report, and we can evaluate the international accounting standard and reporting standards as well. Those being given in the inductive content. So our inductive contents for LO3, we need to calculate these ratio: liquidity, profitability, working capital, which is we call the running capital, efficiency ratio, which also known as use of resources. Resource utilization ratios as well. We'll interpret these ratios and then we'll draw the recommendation, and we'll go through International Accounting Standard IAS 1 and various other international accounting. So all financial statement we prepare under the International Accounting Standard IAS 1, which we already discussed during our lesson 1 as well. Then International Financial Reporting Standards, we have gaps, Journal Acceptable Accounting Principle, Journal Acceptable Accounting Principle for FRS, Financial Reporting Standard 102 and Financial Reporting Standard 105. So which we'll discuss as well. We'll go through those. So now we'll go through IS2. A few headings I'll upload this, please, if you just go through a bit, a bit reading, background reading. Financial Reporting Standard 2 is Financial Reporting Standard 2 is applicable in the UK and Republic of Ireland, so we can look around as well. Small entities and other minor amendments, so which we can, small entities, small enterprises, small organizations. So Financial Reporting Standard is applicable in the UK and the Ireland for the small and the minor amendments which have been amended. So there are a lot of subsection of this where we can look around the guidance about the balance sheet format, which is also International Accounting Standard 1. This guide us the disclosure requirements. We need to disclose all and the notes within a financial statement. So IFRS 2 is a financial reporting standard applicable in UK and Ireland, which is all about how we can present, how we can prepare, how we can report different elements in the financial statement. So I'll explain in FRS 2, FRF Financial Reporting Standard 102. Okay, that's guys all about, and then we can look around next Financial Reporting Standard 105. So now we'll discuss Financial Reporting Standard 105. So financial reporting applicable to the micro entities regimes. So that's we can look around as well. What is this standard all about? So that's 105 is financial reporting standard applicable to micro entities, which is a small entities. Micro means small, and which we can go through as well. I'll mention you. So 105 is all these things will cover: accounting principle, financial presentation, financial and the joint ventures, error estimate. So all these being discussed for micro entities, small organization. So next now we'll explain what is meant by micro, and we'll go through in details. Okay, organization can be divided into micros, small and the medium oblique large companies. So Financial Reporting Council has issued the suitable changes that largely is a response to implement the new EU accounting directive, which is new standard is 105, the financial reporting standard. Micro entities is a new section 1, small entities FRS 2 for the small entities, and the financial reporting standards applicable in both, and the annual review can be under 101 FRS, and then we've been discussed, so financial reporting standards all is being amended and updated. Then we have within that we've been given that guys, we need to really look around the turnover. Turnover of the company is 632,000. Balance sheet total is 316 in terms of the assets, and then 10 so that reporting options is available under FRR S102, which is being amended. So that will give us the guidance. That's the micro companies, which is we discuss 102. And if is turnover is more than, of course, the company can be clustered as a medium. If the turnover is more than that and implies, then it's called small. Otherwise, we can call is big companies. Yes, large company, large turnover. So we just discussing tools. So this will focus on this. Anybody any question? Further, all being in detail, being explained in under a detailed document, which I will upload as well. And please, go through a bit reading. Next, we're looking now overview of ratios. So ratios we can divide into 4 key categories into ratios, or further we can divide into the subcategories as well. So financial ratios is, of course, ratios the relationship between two things, and that will help to calculate and measure the performance of the companies. Yes. Okay, that's we can. Okay, so we can look around the different ratios. So what I'll do, I'll send you the formula sheets as well for the ratios that will help you. So we can categorize into different ratios. We measure four types of ratios. So first, that's all the formulas which I'll show you. Formula sheets. Okay, guys. So these are the formulas: profitability ratios, return on capital employed, return on total asset, return on equity, earning per share, gross profit, percentage, expenses, operating profit, liquidity ratios, uh, then use of resources, all the figures we can find, and we can use the formula to calculate these ratios. These ratios, financial gearing ratios, which is quite, it mean high gear, high risk. If the ratio will come high, it mean high risk will be for the company. So all this which we will discuss during our lesson today as well, and which we already. So what I did, I prepared the template for you as well. So please, when you use the ratio, so you can compare by company or year by year. So you can look around same company 2 years, or you can compare 1 year with other company, and you can calculate the ratios, which we'll go through in few minutes. Okay, so that the ratios is very important, and as earlier mentioned, so we can compare in all been formulas is given in the PowerPoint, these slides as well, and these ratios been interpreted. Return on capital employed, compare the total return made by the company on both loans and the share capital. It's just the profit earned in relation to the resources available. Yes. So then we can calculate the profit margins and various other ratios as well. And then return on equity is mean the how much capital, share capital we invested, and how much profit we generate against it. And we can calculate expenses and revenue percentage. We can calculate asset turnover. We can calculate, and then we have a liquidity, two ratios on the liquidity: current asset divided by current liabilities, which we can calculate as well. Anybody any question? Please, if any question, drop me email. As you know, my email anjum@ukversity.co.uk. Then cost of sales, inventory turnover, which is also known as a UK, which is also known as use of resources, and working capital ratios as well, which we can use, and that will help to calculate. So this is quite good. Working capital cycle, inventory turnover days when you calculate, plus receivable days minus payable days. And we can financial position of the company. Financial position as also is a gearing ratio, as I mentioned, high gear, high risk, for the company. And limitation, of course, these ratios quite good, but we need to look around maybe the ratios based on the last year figures. But it's like in the UK, Brexit, and a lot of other incident happen in the world. The incident will a huge impact. So we need to look around the micro and macro environment. We need to look around other factors such as political like pest analysis, couple of you learn in other units as well, political, economic, social, and technological as well. And we can, because if we're comparing with the big company with the small company, their ratios can be different, and if there is a different season in different companies, that can't be, they give the true result. So that's we need to be look around as well. So I copied few assessments links as well that will help you, and I copied the financial statement, and we can use these, the financial statement by using the formula we can prepare as well. So we'll start, we'll prepare some ratios, and we'll go through in few minutes. So as we discussed earlier, Paprika and Anika, their figures. So let's, quickly show you first. So we've been given the question, we need to calculate the ratios. We have all the figures. So if we want to be gross profit margin, we want to be calculate. So we have a gross profit. Look, their gross profit divided by revenue times by 100. So we can calculate, this. So let's, we'll go through now. We have calculated all these ratios based on the figures which is given. So guys, please, you can do practice as well. So okay, let's, next now, gross profit times 100 divided by sales are all sales, also known as revenue. And revenue also known as turnover. So maybe in one company use the word turnover. So it's the same thing. Please don't need to be mixed up. It's the same thing. So these 16,200 divided by the sale 36 is the 45%. We have a gross profit ratios, gross profit margin. Then this company have 52. Then profit before tax or profit from operation, we have after tax even we can. So we can calculate, this is only 9%. So that was the 45, that was the 9. So in between, that percentage is gone towards where? It's gone towards other expenses. So is around 36% other expenses. So that's 11%, and that's 52%. So 41% is being gone to other expenses for this company. Then gearing ratio, as we mentioned, gearing mean high risk, high gear, high risk. If you borrow more money from, so it's a more risk for the company. So 4,000 we borrow divided by debt to equity, and this is 13%, and this company is the 71%. So this is more risky, Paprika, compared to Anika. Alternatively, we can use different formula as well, because these, different in this use. This is 15%, and other is 245%, which is quite huge risk, for Paprika. Paprika is borrow a lot of money from. And then we have a asset interest cover ratio. This is 11.6 times. Our profit is a higher. This is only 3 points. So this is more risky, Paprika, than Anika. Then asset test ratio, which is also known as the current ratios. So that's, been given. So that's we can calculate these ratio we've been given here. The profit is a better in Paprika, Anika, and Anika. So we can look around, and then they make the decision based on this all being, and then the conclusion being drawn. Then we have a second question when we look the 2.1. So we can go through the question, and then we can go through the answers. Okay, so please guys use the formula sheet and calculate. So we have a second question where we'll use the different ratios as well. So that was the first and the second. Then we have it again, Hamden Limited, and we have been given the 2 years financial statement. We've been given the revenue. Now we are comparing 2-year one company. Yes. And then of course we've been asked to prepare and calculate these ratios, which we can, and we can comment, and we can make the decision and all about, and with standards as well. So that's all been calculated in a CAM. So yes, so you will see there gross profit ratio, net profit ratio, current asset divided by. This is the liquidity ratio. Liquid mean the things which we can quickly convert into. Okay, so that's all is there. Plus, I am going to send you different the further interpretation and article as well. So guys, this is one article is quite good to read, and this is all about the ratios. So interpreting the ratios and limitation of financial ratios. Profitability ratios, one of the most important measures of the company success is its profitability. However, the individual figures shown in the income statement, profit and loss, and all this is all interpretation of different ratios and what sort of the decision we can make, and all being explained, and the limitation of the ratios being explained as well. So that will help you to address your learning outcome, which I already explained here. Okay, so if you have any question, please drop me email, and I'll get back to you as soon as possible. So that's all this today, and let's we'll go through. Okay, so we'll just keep up to here. If you have any question, feel free to drop me email. So today lesson we learn about the financial statement. We discuss about financial ratios, how we can calculate, how we can justify it, and what sort of the decision we can make on the basis of the financial ratio. That's all today lesson. If you have any question, feel free to drop me email. I'll get back to you as soon as possible. Thank you. Bye bye.